Welcome to RCLCO's March macroeconomic update. I'm Scott Bommarito, and today I'm sharing a few economic highlights from the last month. Interest rates remain elevated, and medium and long-term U.S. Treasury yields rose further in February. The 10-year Treasury yield averaged 4.21% over the month and has remained near that rate through the first half of March. The Treasury yield curve is still sharply inverted, with the 2-year yield averaging roughly 30 to 40 basis points higher than the 10-year, and the 3-month yield consistently hovering around 5.5% for much of the last year. On Wednesday, the Federal Reserve announced that it will keep the federal funds target at its 23-year high of 5.25 to 5.5%, and most officials again penciled in 3 rate cuts for the year. They projected the funds rate to decrease to a midpoint of 4.6% by year end and fall further to just below 4% in 2025. Stock indices rose after the announcement, and the 10-year yield ticked down modestly. Monthly inflation jumped up for a second consecutive month in February, adding to January's increase in price pressures. Over the last 3 months, headline inflation was up 4.3% on an annualized basis, and core was up 5%. Annual inflation remained more modest, but still elevated at 3.2% for the all-item CPI and 3.8% for core. Core services drove nearly all of inflation in 2023, and so far that trend has held in 2024. Shelter alone comprised nearly 70% of the all-item CPI increase over the last year. In contrast, core goods prices were down modestly over the last year, as were energy costs. The Fed has indicated that it will continue to monitor inflation reports closely to ensure that underlying inflation has cooled before they begin to cut rates. Several more hot inflation reports, like those we've seen over the last 2 months, may complicate that plan. Employment growth posted another strong reading in February, with 275,000 new jobs added for the month. January's blockbuster initial reading was revised down notably, but remained strong. Monthly job growth has averaged 230,000 over the last year. The last 3 months have recorded even higher growth, averaging more than 260,000 new jobs per month. The unemployment rate ticked up 20 basis points to 3.9% in February, its highest rate since January of 2022, but still exceptionally low by historical standards. Education and health services recorded the strongest employment growth over the last year at 4.2%. The leisure and hospitality, government, and construction sectors also notched considerable growth of just under 3% each. In contrast, the information sector reported job losses, with employment down 1% over the last year amidst highly publicized layoffs at several major employers. Against this backdrop of a strong employment market, consumer spending has been resilient. This chart shows retail sales growth in the 5 largest sectors. Total retail sales grew 1.5% over the last year. Non-store retailers, effectively e-commerce, and food services drove much of that growth. Sales in each of the sectors are up over 6%. However, e-commerce registered a modest month-over-month contraction in February. Both sectors have been engines of retail sales growth for much of the past decade. The latest data seem to portray the U.S. economy as stuck in tension between opposing forces. On the one side, elevated interest rates and stubbornly high inflation threaten an economic downturn. On the other side, a robust labor market and resilient consumer spending constitute a foundation for continued strength. It remains to be seen which set of forces will prevail in 2024. That concludes our March macroeconomic update. Tune in to future webinars as we continue to track the forces shaping the U.S. economy and real estate markets.